Welcome back to another lesson. In this video, we are going to look at a past exam, and we are looking at an exam that was done on April 2023, and our point of focus is on question number 2. We are going to look at question number 2. The question reads, the first question 2A, summarize 5 factors that a firm should consider when making financing decisions. So what should you put into consideration anytime a firm needs to source for funds? Now, the first factor that should be considered is the amount of funds required. You should consider the amount. Consider the amount of funds required. That is the first key consideration. The second thing you need to consider is the purpose for which the capital is required. Purpose for which the capital is required. Number 3, you need to look at the length of time. The length of time for which the money is required. Number 4, you need to look at the size, status, and ability of the business to borrow. The size, status, and ability of the business to borrow. The fifth item to look at is the business current status. The business current status of gearing. Do you have other loans? What are the outstanding loans that exist? The next, you consider the level of profits. The business level of profits and reserves. And finally, you look at the cost of the loan, the cost of the source of finance, So basically, those are the factors you need to put into consideration when you are sourcing or you're making any financing decision. As a finance manager, you need to ask yourself some of these things before you conclude that this is where you want to get the money from. Good. We move on to part B. Part B reads that the following information was extracted from the finance statement of Rainbow Limited for the year ended December 2022. We have the ordinary shares, 750,000 at 20 each, retains earnings, preference shares, and debentures. Additional information. The preference shares were originally sold in 2014 at shillings 104 per share. The current price is 94, although a similar issue can be made at 89 net. Ordinary shares are currently selling at shillings 38.4 on the security exchange. Debentures were sold in 2015 and realized shillings 96 per unit. The current price is 80 and it's anticipated that a similar issue would also sell at 80 per unit. The corporate rate of tax is 30%. Last year dividends amount to 3 million, which was 70% of the net earnings. The company expects these dividends to grow at the rate of 6% per annum, and the dividend payout ratio remains the same. The new ordinary shares can be sold at shillings 40, but in order to guarantee success, they would have to be sold at shillings 35 per shares. You are asked to look or required you calculate the cost of preference shares. So how do we find the cost of preference shares? The cost of preference shares is obtained from the preference dividend divided by the market price per share times 100%. Now, the dividends, you see in the question you are told that this is 8% preference shares. That means the rate is 8% and the par value is 100. Remember, the preference dividends are paid regardless whether the company makes profit or not. This is a constant dividend. So in this case, we are going to take 8% of 100. So we are going to have the dividends is 8 over 100 times 100, giving us Kenya shillings 8. Therefore, and when you're talking about the market price of the preference is the current price, whatever the price, the current price, and it has been given in the question that the current price is 94. Therefore, if you want to find the cost of preference shares, you take the preference dividend divided by the market price, then times 100%, and this will give you 8.51%. So that is how we find the cost of preference shares. 2, you are asked to look for the cost of ordinary shares. Yeah, the cost of ordinary shares. Now, ordinary shares, you have to consider whether the dividend are growing or not. You get the dividend before, or original dividend before the following year dividends are declared, and if they are growing, you take 1 plus G divided by the price or the market price of the dividend plus G. Everything you multiply by 100%. So let's look at the question here. You realize from the question, you've been told that the dividend per ordinary share is shillings 3. Dividend per share is shillings 3 shillings, and there is a growth. The annual growth is 6%, or 0.06. The market price is what the shares, ordinary shares, are selling. The market price from the question here is given as 38.4. So let's now find the cost of ordinary shares. The dividend is 3 shillings. There is a growth, 1 plus 0.06 divided by the market price, 38.40, plus the growth 0.06, everything multiplied by 100%. And here you're going to find that the cost of dividends is 14.28%. So dividends, consider if the dividends are growing. If they're not growing, that means G is not there. You just take dividends divided by the market price of the share. Otherwise, in this case, the dividends were growing, so I have to consider that. Next, you are asked to look for the cost of debentures. Debentures are long-term loan, only that they are not loans from banks. They are loans given by from the public. In this case, we are saying that the debentures here, if you want to find the cost of the debentures, that is the cost of the debentures, you take the interest into the interest of the debenture into 1 minus tax divided by the market price, and then times 100. So how much are these dividend paid at tax? If you look at the question here, you're told that it is 10% debentures. That means the debentures are attracting interest of 10%. So we have to look for the 10%, 10%, and then 10% of, if you look at the additional information here, you're told that the dividends, the debenture is sold at shillings 96. The debenture was sold in 2015 and realized 96 per unit. So let's look at the interest there. If the debentures were sold at 96 per unit, so the interest will be 10% of 96, and this will give us 9.60. Now you substitute in your equation 9.60 into 1 minus tax. Tax we've been told is 30%, so 0.3 divided by the market price here you are told is 80. Then you multiply by 100%. This will give you 8.4%. The market price of 80 is indicated in your question. If you look at this question, you're told that here you're told that the current price is 80. You see the debentures were declared or realized in 2019, 2015, but currently the price is 80. So you come and substitute in your formula here to get the cost of debentures. Good. Number 4 here we are told to look for WACC, that is the weighted average cost of capital. So in this case you have to look at the weights of each and every item here. So we begin with ordinary shares. Let's look at the ordinary shares. The ordinary shares have a weight of, if you look at the value here, let's go to the table here. The value of ordinary shares here. You have, you're told that ordinary shares currently sells at 38.40 on the security exchange. And so we look at the total value. If they are selling at 38.4, and how much is the cost? How many shares do we have? You take the shares here is 750,000. These are the shares. So if you want to look at the total value of these shares, so we shall have 750,000. You see here is 750,000. These are the number of shares we have, 750,000, and each is selling at that 8.4. So this one will give you 28,800,000. So what is the weight of this? The weight now becomes, you get, this is 28,800,000 divided by the total. In this case, we are adding up. We are adding up all the others. That means you need to add up ordinary shares, retained earnings, and preference shares. So in this case, you take the total here to see how much it constitutes. Here, this one is the total here is 39,750,000. Now you do the same to preference shares. Preference shares, you look at the weight. Preference shares, the value here is 500. This is 5 million. Divide by 100 times 94, giving you 4,700,000. So the weights here becomes 4,700,000 divided by the total, which is 39,750,000. This gives you 0.12. This will give you 0.72. And finally, look at the debentures. Look at the debentures. Debentures, look at the value of the debentures. Yeah. That means you shall have 7,500 divided by 96 multiplied by 80. That is the market price. This is going to give you 6,250,000. Yeah. 6,250,000. So what is the weight? 6,250,000 divided by the total value, which is 39,750,000, and this will give you 0.16. Now that is it. Now having identified the weights, then you come and get your work. That means we shall look at the cost of capital multiplied by their weights. The cost of capital multiplied by their weights. Now, looking at, we found what was the cost of ordinary shares from the question. The cost of ordinary share was 14.28%. So come here, you take 14.28% multiplied by the weight, which is 0.72, plus what was the cost of debentures? Now, let's first get the cost of preference shares. We calculate the cost of preference shares. Cost of preference share, it was 8.51. You bring here 8.51 plus 8.51 times the weight, which is 0.12, plus the last one is the cost of debentures. The cost of debenture here is 8.4. 8.4. Remember, these figures are obtained from the previous question. So here we are talking about 8.4. That is the cost of debentures, 8.4 times 0.16. Now, if you use your calculator well, let me use mine here and check. If I use my calculator here, 14.28 times 0.72, I will have, this is 10.2816 plus, this is 8.51 times 0.12. This will give me 1.0212 plus, finally here I have 8.4 times 0.16. This will give me 1.344. Add all of them, plus 1.0212 plus 10.2816. This gives me 12.6468%. Rounded off to 4 significant figures, 12.65%. Now that one becomes your work. That is the weighted average cost of capital. I hope that is clear. Each and every item that you're picking to substitute here, you have calculated it before. So you only needed here to look for the weights. Once you identify the weights, then the rest becomes easier. It's a matter of substitution. Now, we move on to Part C. Part C reads, Umi Limited is contemplating to issue 8% bonds redeemable at shillings 100 per value in 3 years' time. Alternatively, each bond may be converted on that date into 30 ordinary shares of the company. So these are redeemable bonds. You can convert them to ordinary shares. The current market price per share is shillings 3.3, and this is expected to grow at the rate of 5% per annum. The company cost of debt is 6% per annum, and you required compute the following. 1, the market value of the bond, assuming conversion occurs after 3 years. In this case, if you look at this question clearly, you're told that this is 8% bond redeemable at 500 and at 100 per value in 3 years' time. In other words, you're told that all conditions observed, that it has to redeem after 3 years. So the first 3 years, it means the bond will still be non-redeemable. So you find the market value of the bond. Now you begin by asking yourself, what is the annual interest of the bond? Annual interest of the bond. Here, the annual interest you're told is 8%. You see, bond is 8. This one we call this in accounting terms, we call them compound interest. They are interests which are payable. In most cases, bonds pay their interest after every 6 months. So here we are talking about 8% of what? This is 8% of 100 per value. So the compound interest here is shillings 8. Now, and how is it redeemed, or what is the value before redemption? Within 3 years, this one will be redeemed at par. Redemption value is shillings 100. So if you are to convert within 3 years, conversion value within 3 years, remember, if you look at the question, you are told that the current market price per share is 3.3 and it's expected to grow. So by the time you are growing, the time you are converting, what will be the value of the share? That is what we need to know. Yeah. So the conversion value of the share, this share which is trading at 3.3, it is going to grow. You remember the compound interest formula. Is going to be compounded for a period of 3 years, and then there are how many ordinary shares? There are 30 of them. So this is the value of one ordinary share. So when you multiply by 30, you will get the conversion value, and this will be shillings 114.60. Now it therefore means we can be able to find the market value of the bond. Market value of the bond. The market value of the bond here, it is interest. We normally say here it is interest multiplied by the present value annuity factor plus the redeemable value, conversion value multiplied by the present value interest factor annuity. This is should be present value interest factor. So our interest here is 8 shillings. 8 shillings. And then is going to be the present value interest factor here. We are going to take this to be 2.6730 plus the conversion value is given here 114.60 multiplied by the present value interest factor. This present value interest factor, you don't have to memorize them. They are available in you will normally be given financial tables. And if you are not given financial tables, you'll be able to use the formula. You can remember this when we did time value of money. When you're doing time value of money, these things were well covered. So this is 21.38 plus 96.22. That is 117.30. Take note, if these bonds were not redeemable, it therefore means the conversion value could have remained to be the par value. But since they are redeemable, then it therefore means we need to look at the values of the dividends at that particular time, because you are converting these bonds to dividends. Good, that is it. That is the market value of the bond. We'll move on to part 2. You are asked to determine the floor value of the bond assuming redemption occurs at par. So the only thing now is changing here is we are redeeming the bond at par, not at the conversion value. So in this case, the only thing changes here is just the substitution of the conversion value, but all the other things remain the same. So floor value here, floor value, we shall have shillings 8 interest, shillings 8 interest multiplied by the present value interest factor annuity, and it is 6% 3 years, plus 100 times present value interest factor of 3 years 6%. So the only thing that is changing here is the value, the conversion value here we're talking of per. We shall use 100 times 0.8396. So here we shall have 21.38 plus 83.96. So at this point, the floor value of the bond is 105.34. This in case here told that assuming the conversion happens at par value. Yeah, good. And finally, here you are asked to look for the conversion premium per share. The conversion premium per share will be the current market value minus the conversion value. Here we are going to have current market value minus the current conversion value. When we're talking about something is at premium, it means is beyond. Like when you're issuing shares, we say that shares have been issued at premium if the issue price is beyond the par value. If the par value is 10 and you're selling the shares at 12, it means that the 2 shillings on top of the par value become the share premium. So in this case, you're talking about the conversion premium. So that means what you are converting now against the current market. So here, we say that our current market value is 117.30, and current conversion value, if you are to convert the ordinary share today and the dividend is 3.3 and there are 30 of them, so that means the amount you get is just 99. Yeah, so the difference is now what is giving you the share premium. So conversion premium becomes 117.30 minus 99, and this is shillings 8.60 per share. This is 18.60. Yeah, that is it. That is how we get the conversion premium. Otherwise, that's the end of this question. This is what you are expected to do so that you can score all the marks in this question. Otherwise, we stop there. We are going to meet as we solve more questions ahead. Goodbye.